All right, let's begin. Good afternoon, everyone. Thank you for joining us. My name is Dan Genuine. I'm the Executive Vice President of Partnerships at Core Education. I'll be your moderator today. Thank you again. Today's session is part two of a two-part series on capital strategies. Our topic today is mergers, acquisitions, and partnerships. Let me begin with just a few notes on our logistics. As you just heard, we are recording the webinar, and we will share the recording and the slides following the session to all the attendees and those who registered. All participants will be muted off camera. We ask that you use the Q&A feature to post your questions. We'll cover those at the end. And if you have any links or attachments that you want to share with the group, please use the chat feature for that. So again, please use the Q&A feature to post any questions for you. We'll cover those at the end. So I'll invite our panelist, Rick Beyer, to come on camera as I introduce him. Our panelist today is Rick Beyer. He's the Executive Chairman of Core Education. Rick has a unique combination of experience in higher education and business as a former college president and a governing board chair, a successful technology CEO, and the senior operating executive of a $1 billion public company. Throughout Rick's career, he has consistently been at the forefront of industry-leading initiatives and has a successful history of leading organizations through change and growth. He's a regular featured speaker on the topic of business model transformation, mergers, acquisitions, and supporting service organizations, including work with the Association of Governing Boards of Universities and Colleges, the AGB, regional accreditors, Council of Independent Colleges, and the Association of Catholic Colleges and Universities. Rick, welcome to our session on consolidation in higher education.
Thank you, Dan. Good afternoon, everyone. Let's get right into we have a three-part program today, and we're going to move relatively quickly through everything so that we can get into Q&A. Generally speaking, in the past when I've done these, there's a lot of conversation. People want to have maybe answers to specific questions. So I'll be moving through these three parts. Just a little bit about Core Education. We are a supporting organization, a public benefit corporation, and we really operate as a mission critical operating partner for our 22 institutions. Collectively, they have $1.2 billion of budget. This allows us to really provide some incredible depth of resources to our partners in these three areas: revenue, technology solutions, and then also institutional operations and capital strategies, which includes M&A, pre and post transaction implementation. So let's get into it. I'm going to talk with you a little bit about just some definitions. So if you hear me, you'll hear me talk a little bit about buy side, sell side. Not necessarily that colleges are bought and sold, although some transactions do involve an acquisition. But just to try to understand what side of the equation an institution might be. So you can see a buy side, maybe there's definitely where the control will be. The sell side will be giving up control at post-close. So you can kind of see important to just in distinction between the sides of the transaction. So we'll get right into it. The situational assessment, I've been doing these for a number of years, just doesn't get much better. You can see not only the decline, we've got demographic challenge, but number two here, just the overall decline in demand for college degrees has gone down. We're almost at $2 trillion of debt, consumer debt or student loan debt, but also a rise in skill sets, credential, certificate, programming. The tech requirements, I'm going to show you something here in a second to try to put some context on the tech requirements that are growing. And you can see all the other things that are happening here. And so we don't anticipate to see this turning around for quite a while. This right here, I wanted to show the slide on what I'm going to call the technology transformation. The area in the blue is really the demand for campus-based or face-to-face learning. What's interesting is you've got the red, which is really online, but think of that as just digital delivery. But most important, this kind of yellow-orange line in the middle of hybrid. The most important thing to know here that between the red and the orange requires technology. Okay, so even in the orange, they will value some on campus and face-to-face, but without the technology, institutions won't be in that market. So again, tech is going to be a really important part of themes moving forward. You can see about particularly common threads about just small mid-sized colleges in general. Just a lot of themes, and maybe your institutions have one or two or perhaps all of these. But there's just unfortunately, a lot of trends that are not allowing our colleges to operate as best as they'd really like in terms of putting their best self out there in the marketplace. Finally, this ending kind of part one, thinking about what I'm going to call organic growth. So for those institutions that have a heavy concentration there, and there are many that have a heavy concentration of programs that are entirely campus-based, they are going to have to become a more comprehensive institution. So that's going to be required in terms of revenue growth and diversification of revenue. And for those institutions who perhaps are already diversified or comprehensive in their offerings, then growth and scaling and economies of scale are going to be important. And so while organic growth is definitely out there, there's so many great areas to grow, you actually need to think about this through the lens of about a 2 to 5 year period. And it also, these growth initiatives need to be large enough to exceed what I'm going to call the prosperity gap. Too often, growth plans are so small that even if you are able to succeed, it still won't allow your institution to prosper or to get into financial sustainability. So let's move on to, we're going to talk a little bit about the competitive position and competitive environment of what's happening in mergers and acquisitions and partnerships. I'll start with the regulatory. So what we would know is our regional accreditors are now all the accreditors there's no distinction between regional and national anymore, but they ultimately report up to the Department of Education. That's a really important component to understand. And the Department of Education, the DOE, is trying to prevent precipitous closures of colleges. And so what that means is that this actually could have a negative impact on what I'm going to call sell-side institutions, as there becomes some natural pressure placed on the creditors to be more proactive on placing institutions on warning, probation, or removing accreditation, which would actually accelerate. So sometimes in the past, institutions might have thought, well, we have enough time. The accreditor is going to give us a lot more time. They're starting to come under pressure themselves. So no, this has all changed. And then the last bullet, particularly on a rule change that went into effect July last year, that really lengthens the approval time, and really on mergers, and I'll talk with you a little bit about, but particularly on mergers with change of control, there's now going to be a two-step process that's now in effect. That is going to lengthen the time of approval up to, say, about 18 months. Well, it doesn't mean that mergers aren't going to happen at all, but it can complicate a transaction. So we perhaps will see one or two transactions will start as a merger that won't be able to move forward. So we'll get into a little bit more of that, but know that the regulatory has changed already. And then we'll kind of determining, sometimes I'll have institutions say, well, I don't know if I'm on the buy side or the sell side. Can you help us? So I thought I would show a little bit left, not only the buy side, but if you say, I want to remain a strong independent institution, we're maybe not interested in mergers at all, but we're interested in learning, but we're definitely interested in becoming independent and remaining independent. So the attributes on the left-hand side are going to be required, kind of the institutional will and resolve, the ability to focus on transformation and transforming the business model. But definitely what I call strong presidential leadership and strategic boards. If I had to put a bullseye on anything, I would put it on the first one, a strong president and a strategic board. With that combination, it can really, you really can move mountains. Oftentimes we will see institutions where there's just a lot of fatigue. That would naturally kind of set you up on the sell side, or just saying, well, we really don't have a lot of comfort or confidence in our own ability to really execute. And actually, we're really more into incremental improvement. And we have enough assets to operate for the next few years. These are actually really telling signs. We'll talk through that a little bit. These are telling signs that not only you're on the sell side, but they're also warning signs of an institution on a pathway to closure. But no matter what you do, even if you're on the sell side, and we'll talk about becoming affiliation ready, even if you're on the sell side, you're going to need to be thinking about business model transformation to help put together an effective value proposition. One of the things that often happens when people will think about mergers and acquisitions, they'll just think about one type of transaction, because naturally people might move towards number four. Well, you're going to combine two institutions together. We're going to get economies of scale. Oftentimes, and because generally in business, that's kind of what happens. But in higher education, there are a number of different types of transactions that can be done. And it's really important, if you're on the buy or the sell side, all of these are options. I'll talk a little bit about coordinate agreements here, or supporting organizations such as CORE, what can help. One-to-one affiliations, oftentimes you'll see this with colleges who are aligned with hospital systems. But we'll go into a lot of these, but obviously number 6 is probably no fun and you want to avoid that. But I think sometimes colleges might say on the sell side, well, we don't want to merge number 4, so they don't think about what's available, and because the number 1, 2, and 3 could actually be available as viable alternatives. So generally speaking, on the buy side, kind of what's the strategic rationale for maybe getting into mergers, acquisitions, and partnerships? It's generally a couple of big things. When organic growth alone, you just won't be enough. You just don't have the time. It could become both a build-buy decision. Well, we have the money, but we just don't want to take 5-7 years to actually get to our result. We would rather accelerate that result and do something along the lines of a map strategy. And also there's a window of opportunity. We are going through a consolidation era in real time. So there's an opportunity on the buy side to make some very strategic gains and competitive position gains during this period. On the sell side, preserving legacy and mission. And again, it doesn't mean that you have to do a merger. There are other different kinds of transactions that you can do. But you may also be thinking about how can we transform our institution using a map strategy. And then also when the financial metrics really provide a clear indication that the institutional survival is at risk between, say, 3 to 5 years out. And I'm going to show you an example here and some things that you can do. So I'm going to talk a little about both, kind of go back and forth on buy and sell side, but here's some interesting things on buy side. You're really never too small to go on the buy side. It really requires the leadership, presidential leadership, and a strategic board. And generally speaking, a lack of imagination will hold back, and it doesn't matter if you're a buy or a sell, but oftentimes a lack of imagination will hold back. There's some insecurity about moving forward, and sometimes even just the inability and institutional will and resolve to become knowledgeable of what is happening out there and to learn about what is possible. And this number 3, I said there's institutions out there that they just shouldn't be doing deals, but they're completing successful transactions and proving their own competitive position and financial model. So on the buy side, this is not left to the biggest institutions. It's really going to be left to presidential leadership and a strategic board. So I give hope to even those smaller institutions that you can absolutely do something in the areas of map. Now, let me just give you a history lesson on this. So New Hampshire College, we all know New Hampshire College, and they were founded and in 1971 started building campus. In 95, they went into internet-based learning. These are their words on their website. And today, Southern New Hampshire is 2,800 students on campus, 170,000 online students, and more than $1 billion in net assets. Now, what I'm suggesting here is that we don't necessarily need to become a Southern New Hampshire, but it is telling of what a small college can do with presidential leadership and a strategic board that has actually had a major impact on higher education already. So you just saying, well, we're too small, we don't have the resources, those are things that will actually hold you back from potentially some really great things that you can do. Here's another example. A small college, Hilbert College, acquires Valley College. And Hilbert is a very traditional liberal arts college, maybe a little over 1,000 students in Buffalo. They created a nonprofit holding company. That holding company bought a for-profit college that'll ultimately transition to nonprofit. But there was a strategic rationale about expanding programming and geography, and the transaction more than doubled the growth. They expanded online delivery, their online delivery it's financially accretive. And so here was a small college with leadership and a strategic board. Uh, and so this is not a Southern New Hampshire, but it's a real time example of what can be done with leadership and a strategic board. These transactions really closed probably a year before that, but St. Joseph's has done multiple transactions now. But the point is, when they did University of the Sciences, they were $100 million in revenue and more than that in net assets, and they were on the sell side. And then Pennsylvania College was a transaction that closed in 23, a smaller, but they became part of St. Joseph's University. So this was very strategic, all aligned with healthcare. I'll just focus in for a second on what I'm going to call a coordinated agreement. This particularly is where you might have some colleges that you're really close by, maybe 3, 4, 5, 10 miles, or where there's reasonableness between going back and forth. But what's interesting here, this has been an agreement that has been placed for decades, and they've refined it over the years. It wasn't perfect. They continue to refine it. But the students enroll at either college. They take the same classes, and they do a shuttle bus. But more importantly, they've been able to get the benefits of the financial merger while keeping both institutions independent. I think we're going to see more of these, but there's going to be some limitations because of geography. But this is something that, in the right circumstance, can happen. I've seen transactions whereby two institutions, when they start to do this, they literally will dramatically improve their cost of goods sold on delivering academic programming. I mean, significantly improve it, which really helps the overall business model. Again, not for everybody, but for maybe transactions where there's some geographic closeness. We've had a closure just over the last month, and it's unfortunate with Notre Dame College, but I thought I would do some research on this, and they're relatively have been always been a small college with very little endowment and a weak balance sheet. So the college had about net assets on their last public audit of 17 million, debt of 18, and endowment never more than 10 million. But from 2015 to the present, the college continued to experience declining tuition revenue. And pre-COVID, so pre-2020, the institution was in a declining financial position. Now, how do I know that? Well, those are public. These are public. This is all public record in terms of 990s and the audits. And so all indications were present probably 10 years ago that regarding the risk and the financial condition. So what tends to happen is, I'm going to call board leadership, because this is all where it lies, that will unfortunately have the tendency to run out the clock and say, look, we've done everything possible, but we might have said, like, what might have been done between 2013 and 2023 to protect that missions and legacy. So there's some fear of loss, but when you look at the financials were really clear about what should be done. Now that's hard, but the numbers basically said that they should do something different. And then why do the institutions start too late? definitely maybe a hope and a little overconfidence that we're going to be better, even though the signs point to continued deterioration financially. There's oftentimes a few board members have very clear vision, but the balance of the board is just not fully engaged. These are just kind of what we've seen into the market about what happens. Um, and About starting too late. I'm going to talk a little bit about timing here as well. Let's take a look at a proactive strategy. I'm familiar with this institution, both of these institutions, but in 2019, so about 5 years ago, St. Augustine president and their board chose to just become more knowledgeable on the consolidation era. So this was actually pre-COVID. Start to say, what's happening out there? What might we be thinking about? And over a period of years, they just quietly explored what was out there with the number one goal of maintaining their mission and legacy, knowing that whatever they might do is going to look different from the past. And then you had Lewis University, their president and board leadership. They made a strategic decision several years ago to just address that combination of organic and inorganic growth strategies, which ultimately led them to St. Augustine. So now, today, the St. Augustine mission and legacy serving Hispanic students is well intact, and they're now part of a stronger community with Lewis University. So just the tales between, sometimes there's a fine difference between, I'm going to call success and failure, but very important that we really know our numbers about how our balance sheet, how strong or weak our balance sheet is, and what are the trends that could give us some really clear indications that maybe we don't want to do something right now, but maybe we should be learning, and maybe we should just understand how we may want to get prepared. But today, there's some institutions with $50 to $100 million of net assets beginning to do their process to become affiliation ready as a sell side institution. Okay, this is how the market has already changed. And we're likely to see like a 20-to-1 ratio, 20 on the sell side, 1 on the buy side. So becoming what I'm going to call affiliate ready is really a strategic initiative that can really allow you put your institution their best foot forward. And even what I'm going to call even on the buy side, well, through a process we can talk about, you can actually really put your best foot forward in this. So kind of why transactions fail, even after a letter of intent. And I would say most transactions, even after a letter of intent, will fail. And these are just some reasons why. But on the buy side, actually the buy and sell side, probably the consistent is the lack of process, lack of board process. On the buy side, too fast. We're going after a transaction too fast. And there's a group of board members who really get it. And the balance of the board is not quite caught up to speed. And what happens is that there becomes a revert to the mean, particularly after you see, okay, there's the strategic rationale, we see the financial benefits, we've got it, but then all of a sudden, the full board starts to question, do we really have this ability to fully execute this? We've got a lot on our plate already. Everybody's doing a lot. And what happens is the revert to me comes to the mean a transaction doesn't happen. This is as an operating partner, Core is doing this today. We're actively involved in the market and actually doing post-transaction implementation, pre-transaction planning as well. On the sell side, you can see lack of process, failure due diligence, and not having the right value proposition, but also the board's just unwillingness about really understanding and fully grasping change of control and what that means becomes a little bit too emotional for the board. But again, that could have been solved with good process months earlier. But these are just some high level things of why transactions don't fail. So now we're going to go into the last part, and we're going to talk a little bit about getting ready, preparing, and completing a transaction. I wanted to start with just people saying, how long does this take? It really depends, because sometimes an institution might be in along the lines, but I started backwards. I started with, if we didn't do anything, let's start backwards with regulatory. So you can see this could be a 6 to 18 month period, depending on the kind of transaction. A definitive agreement could actually take a couple of months to put together. This is really all legal, but I've seen them take easy 2 months. Due diligence can take 2 to 3 months. You want to try to get definitive agreement to overlap with some due diligence, but oftentimes institutions won't start that definitive agreement because that's really a little bit more heavier on the legal side until they're comfortable with due diligence. So there tends to be a little bit of sequentialness go there. This is what drags out timing. But now getting to a letter of intent, once you have a letter of intent, generally, no, not generally speaking, you should always expect there's going to be exclusivity. So once you sign, those two institutions will be bound to, at least it's non-binding, but they'll be bound to working together, and the sell side will have to stop negotiating or seeking other alternatives. Number 5 and really number 7, or next, there's all kinds of number 5 and 7 are really potentially long. But let's just go to 7 for a second. It's really board alignment and authorization. The market research does not take long at all. But once you get what I'm going to call the decision matrix lined up, but getting the board, the full board, and you can do that through process, which I'm going to show you how. Then the maturing of the relationship. Sometimes the sell side's ready, but the buy side's not ready. And sometimes the buy side's ready and the sell side's not. So you actually have to get that relationship, because there's two parts of a transaction: the technical part of the transaction and the relational part of the transaction, and they're equally important. So this is where time will tend to lie. So maybe sometimes might say, well, we're already been talking, we're ready to go into a term sheet. Okay. Or ready might mean that you might not yet have it. So there's still some work to be done in number 4. And then it would need to move into these next areas. So try to give you just a little bit of feel on these gating decisions. I've always liked to do, when you're trying to move a body like a board forward, is think about awareness, understanding, alignment, and then decision readiness. And sometimes, I'll talk with you about a process that includes a task force, executive committee, and full board. And you have to think about making sure each one of those groups, first of all, are aware and understand, right? And sometimes you'll get maybe a small group they're aware of it, they get it, they understand, they're ready to go, but the rest of the board is not even really fully aware, or they fully don't understand. So there's some questions that you have to answer both on the buy and the sell side to get to what I'm going to call the starting line. Once you can do that, there's some things that you can do with endorsements along the way, with small yesable decisions, which I'll talk about. But here's an example of this, a task force. Even if the buy or sell side, I like using a little softer terms like long-term strategic partnerships. It's a little bit more vague. Let's set up a task force on long-term strategic partnerships. And that needs to be some very strategic board members along with the president. But then they can become they're going to become aware and understand and align probably faster than anybody. And then they'll have to get the executive committee along the line, and then we can educate the board and get them aligned. And what we're going to talk about is getting what I'm going to call these yesable decisions and endorsements, and these gating decisions along the way that really will help you to a sound strategy and successful deal execution. So this would be an example. There's so many yes/no gateways. Sometimes, because of a lack of understanding, you might, boards might think, well, we're going to go from step 1 all to this green, in one meeting. And the fact of the matter is that there's all different places where the transaction could either go south, or you can use good process to move it forward. But I think giving the board reassurances that there are going to be some natural gating decisions and natural yes and no gateways. Oftentimes, knowing that from a board, it's like, okay, good, we're not rushing to close. But at the same time, this will actually be your fastest pathway when you put some process along the line, and then you use this task force, executive committee, full board. I always like to say the full board can topple with a feather with good process, because you've really taken the time to use that committee structure and educate the board along the way. Some buy side considerations of a transaction. There's generally what we'll do is help you create a decision matrix that will help put some discipline around research, and also some context of when you ultimately find an opportunity or two of how you can communicate the rationale to other board members. Okay, and then once you find that, what is the strategic rationale to do this? And is it financially accretive? Because there you have to do you're going to have to do different levels of financial modeling. And we have modelers that can do like level one modeling to just do a gating decision. Do we think we can get this to be financially accretive immediately? And then, of course, through a series of gating decisions, more and more financial modeling will be done. Having a credible implementation plan, this fourth bullet is going to be on the buy side where there might be more risk for a transaction not to happen. And this is a lot of area where we have a lot of experience in terms of developing the plan so that the board can feel comfortable, like, okay, we've got some support around here. We on this transaction, we've got comfort that we have a good team in place to address all of the implementation assumptions. Deal momentum. Most LOIs won't close. You're going to see when they start losing momentum. Generally, it's due to a lack of governance process or something's gone awry. And you want to try to do is get really quick no's. Too often, what I'm going to call the elephants in the room are not addressed. Oh, we're going to handle that later on. We're going to handle these are like really important things, and then you find out um, I had a transaction a while back, but the person that was there are two institutions, and they both thought they were on the buy side. And for one, I said maybe you should find that out. And like, oh no, we're on the buy side. Oh no, we're so that transaction didn't happen. But you didn't want to waste a lot of time. Also, there's a qualification process in here to make sure that when you're talking to another institution that they're actually qualified, they've actually gone through a few steps themselves about being ready for a transaction. So just in summary, we're going to open it up here in a second. There are far less buy-side institutions in the market, which represents really significant opportunity. And that combination of kind of organic and inorganic really can create some incredible, interesting opportunities during this window of opportunity. On the sell side, I would just say time's the enemy. Good process will make the difference on both sides. Becoming affiliation ready is really important. It's how a sell side will outcompete the other 19 institutions. And if you do have a weak balance sheet, it's an indication that help's needed. Because what happens when you have a weak balance sheet, and then these times you can get wild swings in results. Maybe not like we could in the past, whereas maybe it was just a little kind of bumps and bruises around the way, but we're getting big ups and downs in performances. And when you have a weak balance sheet on the sell side, when you have a big drop, you're unable to respond. So just that alone is a pretty important indication. But business model transformation, no matter what you do, is going to be needed to become and remain a independent institution. And then finally, Dan, we'll open it up to questions here, but just let you know we're very active in the both buy and sell side process. I think probably one of the important things is this time to market. We can help accelerate the time to market, but where oftentimes there might be different people that you bring in, well, let's go find another institution in this and this. We can actually stay with you and help you develop the entire strategy all the way through your modeling and developing all the pre and post and staying with an institution post transaction. So Dan, let me stop here and open it up for questions. I'm sure we probably have one or two.
Yes, you do have quite a few. I'll just make one final comment there on that last slide that CORE is active on both the buy and the sell side of the equation and helping institutions find their way forward. Ready for some questions, Rick?
Yeah, absolutely. Fire away.
Okay, very good. So first question here, how do I move my board to do a buy-side transaction?
Great question. We'll start with process, and it would probably start with the president. So a strong president, a leader, a strong leader as a president can actually move a board because the president is the one who's going to provide the vision. So one of the things first the president could do is get together a small task force again. Just say, look, I'd like to ask you, and depending with the board chair, let's not even worry about mergers and acquisition. Let's get together right now and just form a task force. what I'd like to do is study the business model transformation, because you're as an institution, you're either growing or shrinking. You're really not ever staying still. So as a president could really use this as a great concept. All I like to do is get my 3 or 4 or 5 best strategic board members, and I want to talk about where we need to be. We'll talk about the prosperity gap in that, about because there's quality of earnings as we get into this. Was for another webinar, but quality quality of earnings and prosperity gap will show the distance, even on the buy side, that an institution needs to be to achieve to get long-term financial prosperity. So just through that part and business model transformation can then lead to a question of organic and inorganic growth. Okay, as opposed to saying, well, you should go right into M&A. So probably through just a little bit backing that up and thinking through about your prosperity gap, strategic growth building blocks, and all of a sudden now organic and inorganic growth, and then the strategic rationale of what can be done in areas like either things are build and buy, like wow, we need to really step up our game in healthcare. Well, we could, or we could go on the buy side and find another institution and really do some interesting partnerships. So maybe not approach it immediately as M&A, but approach it through business model transformation. So we're very much involved with that. It's a great question. Next, Dan.
All right. So the next question is, why does it take so long on the regulatory side?
Yeah, I think 2 things. One, there is definitely a change as of 2023. And so what's happening is that this 2-step, the DOE will not even consider looking at a transaction until the regional accreditor, what we knew as the regional accreditors, approve. So there's kind of a 2-step process now. Now, that's going to be on areas of what I'm going to call change of control, and which generally speaking is a merger. Okay, there could be some other things like cooperative agreements, maybe sometimes an affiliation that does not have change of control, that might just do something with the former regional accreditor, which is going to be maybe a 3 to 6 month process. So it depends on the transaction. Also, it's important that when you're doing, there's different ways of how you want to start communicating in the transaction process. Generally, especially when you're close to getting you're past the letter of intent, but you also have to understand the sequence of how your regional accreditor works, because you can miss a date and all of a sudden get pushed off 3 months. So in a regulated, we're a regulated industry, unfortunately, and these are the processes that we have to follow, and they haven't gotten any shorter. Even on the mergers, sometimes the institutions will have to operate that second institution independently. Now, there's a whole lot of things that actually can be done, but there's still a level of separateness. It can become part in its phase 1 in the change of control, but there's still, from a financial aid and the OPEID number, that will have to remain separate. Those are a lot of new things that can complicate a transaction, which again would always say that this is why you want to try to know what's out there, what kind of transactions are out there on the sell side. Means don't start too late, because that process alone could be negative for a transaction.
Great, thank you. Here's our next question. How do you balance a shared governance model with the confidentiality needed in this process?
Yes. First of all, probably some clarity that the board has the ultimate fiduciary responsibility, unless otherwise stated in your bylaws. So this would be really goes to your bylaws. This is not a group decision of faculty and staff and everything. And so it very much is the most serious, that along with selecting a president, decisions that a board needs to make. What I have seen, this is where you really want to keep tight communications. On the sell side, announcing something that you want to look for something is generally a sign of weakness. It's not looked upon in the market as something that's very attractive. There are much better ways to approach the market in a position of strength versus weakness. I have seen institutions, as they start to expand slowly. The people that need to be in the know. I've seen confidentiality agreements signed by VPs and everything. Um, there's questions like will it be held or not, but that process has a level of seriousness to contemplate. But it isn't. I have not seen a good deal where you open it up and have all kinds of dialogue openly, because it's just you think about process, that's really not the process you'd want to go down, because really the board's abdicating its responsibility by looking to have other people make the decision. This is a real serious decision on boards, and if an institution fails, ultimately it's on the board.
All right, thank you for that answer. Another one here, related to cooperative agreements. Are you seeing any traction with transactions that are not traditional full mergers or acquisitions, but more shared services or systems approaches that allow more autonomy for institutions, but efficiencies? Cooperative agreements without a change in control, essentially.
Yeah, I think, and it's a good question. It's right on. I think what happens is when let's just take that DOE two-step that could add another 18 months on top of that 6 months. It could be 2 years, right? What happens is that when you might have a reaction or some kind of a policy change that might put certain hurdles on one kind of transaction, it opens the door for other transactions, right, to happen. So whereby cooperative agreements and supporting organizations and affiliations, they're out there. But all of a sudden now it's like, yeah, we need to at least explore these. So I think one of the things that out there, if there are two institutions that are very close by, nearby each other, there's some very interesting things that can keep institutions independent, but have some incredible economies of scale. There are supporting organization. CORE is a supporting organization, but there's no change of control, so the institutions have full control of what they do, and we serve at their pleasure. But there are some other. I mean, TCS is a really good institution out there. There is change of control that is involved, so that could also mean a couple of years on that change of control. I think that we're going to see just a lot more innovation, where again, when one segment of the market has a little bit more, we're still going to see mergers, and we're at CORE involved with one right now in post-transaction. It's going through a two-step because that's how that transaction was put in place. But I think we're going to see some other ones that's going to, what I'm going to call, blur the lines a little bit, because the time to market becomes critical. They can't wait for 2 years to kind of run things as is and then make change 2 years from now. So the answer is yes, and I think that it's going to be. I think that's going to be positive for the industry. Dan?
Great, thank you. Another question, can you share some comments on deals where the acquired institution may be operated as a satellite campus and potentially in another state?
Yeah, absolutely. Well, let's take a look at, let's just look at one transaction I know closely was Hilbert buying Valley. I mean, Hilbert was a Middle States, Buffalo in Middle States, and Valley is located in kind of Cleveland area, right? And so there were two. Now they're actually two different entities, but I definitely think when you start going down and thinking about a satellite campus, there's some incredible things that can still keep identity, legacy, even like athletics and co-curriculars, even in different conferences. There's lots of things that can be done. So that's a really good idea. Is when maybe a door closes over here, it might open one or two on the other side. And that's where I'm gonna come all the way back to what I was talking about here. And this is why, by being with CORE is very active in the market, that we're able to really help look through what might be the options of what kind of transactions might be the best. Clearly the legal and everything, but is there, but even before, oftentimes legal aren't aware of all what's available. Once the transaction structures, then the legal can execute on it. there's a lot of strategy involved in particularly 1 through 4. But even in 5, there's some late life mergers. They're really not mergers, but they can be today. Really, the communications around number 5 can look vastly different, because oftentimes there's certain situations where they want to keep a campus open, but they want to go down to one OPEID number. Okay, so actually you end up keeping brands legacy, but you end up going to one OPEID number. Okay, and so this is where again a little bit of innovation will come in on the transaction types, that when we start looking through not only research about what lines up in the market to the decision matrix, but then when you find institutions, there's multiple paths to success. You can do 2 and 4, you can do 2 and 5, you can do all different kinds. You can do 1 and 2. There's all different kinds of combinations. It just isn't into one area. Dan, back to you.
All right, thank you. I think this next question goes back to your comment earlier about most letters of intent not progressing through to a definitive agreement. And here's the question. As a buy-side institution, we spent a lot of time on a transaction that didn't close. Now our board is nervous about M&A. How do we manage this?
Yeah, again, let's just go back to process, right? Or getting the elephants in the room sooner than later. And sometimes, and there's ways that you can do that in a very effective, or just being qualified. Yeah, I have seen, unfortunately, transactions where on the buy side, the board wasn't fully convinced about going into transactions, so they went into an LOI. And that just, again, that's kind of, pushing the elephant in the room out, because when push came to shove, then the revert to the mean happened. So, but also time, it could be a sell side issue. So I would say that first and foremost, if they were shy about moving in M&A, as the question might indicate, the question would be, was there a really good reason to go into it in the first place? To have a really clear strategic rationale with the presidential leadership, with that task force. This is the why. And really even realize and letting people know transactions will come and go. And sometimes the farther you get down a transaction, the harder it will get, right? This is now you're starting to get in all the little details. So it's okay to manage the expectations of the board through the task force, through the executive committee, that these are sometimes how things are played out. But just the ability, if somebody's gun shy afterwards, then one might also think about what was the premise for doing or looking in the first place. So it will come down to process. But again, presidential leadership can really be helpful here. Dan, back to you.
Great, thank you. One more here. Is there a possibility of a merger between equals?
I would generally say no. I would generally say no. I would say yes, the answer is yes, but one's more equal than the other. So generally speaking, you will know which side of the transaction, and that would be something that you'd want to address early, sooner than later in a transaction.
Well, that question makes me think of your comment about the pair of institutions that each thought were on the buy side.
Yeah, they fortunately found out a little early. They did. We recommended, why don't you just have a friendly meeting and just put that out there, and it was ended up being a really positive meeting. And they laughed a little bit, but they said, okay, let's part friends. Okay, so but yeah, there's a lot of opportunity right now. The market has already shifted. So even if institution wasn't interested in a buy side or a sell side, transforming the business model is absolutely required. The market has shifted on tech and digital, where the vast majority now students will either demand fully online or partial online and in person. But in either one, it requires technology. And then when you start looking at what I'm going to call that prosperity gap, that we start with either the buy or the sell side, because it puts context on the journey. And even on the buy side, there are some really big quality of earning gaps, which sets context on the reason why growth is required, and not just growth, but growth with the incremental margin accompanying with that growth. So growth without the marginal accompaniment is nothing. So, but what you have to be able to do is when you have that prosperity gap, is determine how are you going to fill it over, say, a 3, 5, 7 year period. And at the same time, you have to meet, fall goals, right, in August of this year. So there's some really daunting things. But when you have an understanding of your context on your journey based on the quality of earnings or where you're at on your prosperity gap and how much growth you need to be prosperous, then all of a sudden it can start to say, okay, what kind of growth? And we can think about strategic building blocks in big areas. And then sometimes mergers and affiliations, partnerships become part of that growth, inorganic growth. And then second of all, sometimes the gap on the, becomes evident where an institution says, we really don't have the wherewithal. I would not worry about funds, raising money. That's the one thing you should not worry about. Money follows great plans. And we've seen this with Core. We've seen and we've helped our partners raise money because of business model transformation ideas and plans. But one of the things that I would encourage institutions, even if they might think they're on the sell side, is think from a position of strength and not from an inferior position or of weakness. We don't have the money, we don't have the budget, we don't have the donor base. Those are all those put self-inflicting limitations at the start. Put those aside, and if you have the ability to have presidentship, if you're fortunate to have presidential leadership, then you just run those prosperity gaps and you think about what are the 3 or 4 or 5 strategic building blocks. Now you might say, well, it's going to require investment. Absolutely will, and you won't have money in your budget to do it. The problem is too many times people are trying to take money, tactical money, for strategic purposes, which never works. So with a plan, you can say, okay, well, let's now figure out what the capital strategy is for institution. If we need another 10, 15 million to launch this, let's go not a needs based. We covered this in our last webinar on venture philanthropy, but which is more opportunity based fundraising as opposed to need based fundraising. And there's a lot of big money out there for project based, opportunity based fundraising, which we'll call venture philanthropy, that can help transform the model of institutions. Now, sometimes, it requires maybe an institution that says, yeah, we think we'd like to be part of something bigger, but we don't want to merge and we don't want to lose this, but we want to find something else. That's okay. But because there's more than one pathway to success, but it will come down to leadership at the board being strategic and having a presidential leadership that says, okay, just doing the same things better are just not going to be what's going to be required for our institution, just because the market has shifted so much. And so, Dan, I don't know if we have any other questions. I know we had quite a few.
Yes, I've got another question related to the board.
Okay.
And in this case, there's a couple of board members who believe that mergers and acquisitions should be considered. The rest of the board is cool to the idea. How do we navigate this?
Yeah, I think that sometimes people being cool to it could be, I'm not aware, I don't understand it, or even might be, I've done things in business and I know how they work. But in higher ed, this is a lot different. Now, the people aspect of it and the operational aspect, there's a lot of similarities, and that's why post-transaction implementation is so critical. But going back to that one slide that had all the different possibilities of different transactions. So I think one would be to start on long-term prosperity, and thinking about long-term prosperity, and then just becoming educated with the task force. Use that to educate the board. And as the board starts to see the prosperity gap of what it's going to take, and sometimes you get just that incremental, well, let's just get another 50 or 100 students. That'll help us. And it would probably help, but it will do nothing, absolutely nothing for your long-term prosperity gap. And by doing that, running that prosperity gap and thinking about having the institutional will and resolve to serve new markets, to serve new students, Sometimes institutions are uncomfortable with doing that. And it's okay, but you want to kind of go into that more consciously. I'm seeing there's a segment of the market out there that is institutions that will have some pretty good size endowments, but when you peel back the onion on their audits, um, they're incredible users of cash, of external cash, but they're so big that they really don't care. They just consume it because operationally it's so heavily negative. Now, these aren't institutions that I'm talking about with $1 billion of budget of endowment, but these might be institutions that might have 150 to $300 million of endowment. But when you pull back and you do a quality of earnings, you look at what I'm going to call operating revenue, and you put non-operating revenue, which would be I'm going to call the external revenue aside, and put that over there. You all of a sudden it starts to expose the voracious consumption of cash that the operation requires. And what happens sometimes you in that segment of the market has just become accustomed. Well, that's the way we do it, and that's okay. But what's now we're starting to see that's a real potential danger because that's hard to change of running that big a negative, and you'll have some really incredible challenges there. But I think that in other parts of the market where you're more tuition driven, transformation of the business model is definitely critical. And and that's part of our mission at Core is helping institutions transform their model. And if mergers and acquisitions partnership is part of it, great. And if it isn't, that's absolutely great too, because there's multiple ways to get to success. Even if you're a small institution wanting to stay independent. I would just offer in conclusion, I know we're finishing up here. Dan, thank you so much we had a really good turnout. Anybody that would like to talk to myself or Dan, just reach out. Be happy to have a little Zoom session and continue the process. But a really great session, great questions. And Dan, thank you so much for putting everything together. I'll turn it back to you for closing comments, Dan.
Yes, just thanks to everyone again for joining us this afternoon. Want to remind you that you'll receive an email with a link to the recording as well as slides from today's session. And as Rick just said, maybe you have some questions that you'd like to explore in greater depth and privately. You're certainly welcome to reach out to Rick or to me, and we'd be happy to schedule some time with you then. We're coming up on 2 minutes to the hour. Any final thoughts, Rick, as we wrap up?
Thank you so much, Dan. Really nice, great questions by the audience, great turnout. Thank you, everyone.
Okay. Thank you.
Thank you.